Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about New Jersey Resources Corporation quarterly report. New Jersey Resources Corporation provides a diverse range of businesses and services to its customers. At the core of its operations is the distribution of natural gas to residential and commercial customers in 6 counties in New Jersey through its natural gas distribution segment. In addition to regulated utility services, the company also offers capacity and storage management services, as well as participating in off-system sales and capacity release markets. Its Clean Energy Ventures segment invests in and operates clean energy projects, including solar installations across several states. The company's Energy Services segment provides a range of physical wholesale energy, retail energy, and energy management services, while also maintaining and transacting natural gas transportation and storage capacity contracts. The Storage and Transportation segment invests in energy-related ventures and offers shared administrative and financial services. Furthermore, the company provides various home services, including heating, ventilation, and cooling services, as well as sales and installation of appliances, electrical and generator service and installations, and plumbing repair and installation services. It also holds commercial real estate properties and offers natural gas storage and transmission asset services. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to increase. The stock price of New Jersey Resources Corp. has increased slightly over the past year due to several factors. One possible reason is the company's strong financial performance. If New Jersey Resources Corp. has reported higher revenues and profits in recent quarters, investors may be optimistic about its future prospects, leading to an increase in stock price. Another factor that could contribute to the rise in stock price is the company's strategic initiatives. If New Jersey Resources Corp. has made significant investments in new projects or technologies, it may have improved its competitive position and increased its potential for growth, making it more attractive to investors. Additionally, changes in industry trends or regulatory environments can also impact a company's stock price. For example, if there is an increase in demand for the products or services offered by New Jersey Resources Corp., or if new regulations benefit the company's operations, it may lead to higher stock prices. It's worth noting that these are general factors, and without specific information about New Jersey Resources Corp., it's difficult to pinpoint the exact cause of its increased stock price. New Jersey Resources Corporation maintains a market capitalization of $5 billion, broadly in line with the industry peer group. New Jersey Resources Corporation trades at a lower price-to-earnings ratio of 16 times, and a higher price-to-book ratio of 2.18 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 3.67%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth and decline can be identified through an analysis of various factors. On the growth side, customer demand influenced by weather conditions is a significant driver, as well as regulatory decisions such as base rate cases and rate requests. Capital expenditures associated with customer growth and infrastructure projects also contribute to revenue growth. Additionally, increases in utility firm gross margin and BGSS incentive programs due to higher margins from off-system sales and capacity release, are notable drivers. Regulatory decisions continue to play a crucial role in shaping revenue growth or decline. For instance, the sale-leaseback arrangements of natural gas meters and commercial solar projects have generated significant revenue. Furthermore, increases in operating income at Adelphia due to rate case settlements also contribute to revenue growth. On the other hand, revenue decline is primarily driven by decreases in CIP rates and annual recoveries. The decrease in CIP rates has resulted in a loss of $26.2 million, while the reduction in annual recoveries has led to a decrease of approximately $1 million, effective October 1, 2025. In conclusion, revenue growth is influenced by a combination of customer demand, regulatory decisions, capital expenditures, and increases in utility firm gross margin and BGSS incentive programs. Conversely, revenue decline is primarily driven by decreases in CIP rates and annual recoveries. The net income of a company underwent significant fluctuations between 2019 and 2025. Initially, it improved from a loss to a range of $938 minus $1,480 on page 2. However, by page 45, it decreased due to various factors. The net income continued to fluctuate, with an increase from $48,130 in 2019 to $130,960 in 2022 on page 41, and a decrease by $8.83 million, 6.7%, from 2024 to 2025 on pages 45 and 46. Despite the fluctuations, there were instances of net income increases. For example, it increased by $157 million due to a base rate case increase on page 47, and by approximately $38.1 million due to an increase in BGSS rate on page 50. Additionally, the net income increased from $10,258,000 to $20,597,000, 100% increase, on page 57. Profit margins also experienced changes during this period. On page 5, they decreased for gross profit margin and operating profit margin from 38.8% to 29.6% and 38.8% to 29.7%, respectively. However, there were instances of profit margin increases, such as the increase in utility firm gross margin from 20.1% to 23.4% on page 53. The fluctuations in net income and profit margins can be attributed to various factors, including changes in commodity prices, base rate case increases, and favorable pricing spreads. Overall, while there were instances of decreases, the data suggests that the company's net income and profit margins improved in some periods due to specific events or circumstances. The company's financial performance has shown a significant improvement in its operating cash flow over the past year. In 2024, the company experienced a negative operating cash flow of minus $8,955. However, in 2025, this figure turned positive with an operating cash flow of $26,728. This marked change is evident when comparing the 3-month period ending December 31, 2024, and 2025. In 2024, the company reported a negative operating cash flow of $9M, but in 2025, this figure increased to $26.7 million. This substantial increase indicates that the company has successfully turned its financial performance around, generating positive operating cash flow for the first time in recent years. The shift towards positive operating cash flow is a significant achievement for the company, as it reflects improved management of its operations and better financial health. This trend suggests that the company's efforts to optimize its business processes have paid off, enabling it to generate sufficient cash from its core activities. The company's debt level has experienced significant changes over the past year. According to the extracted summaries, long-term debt for NJR increased from $1 billion to $1.1 billion, while for NJNG it rose from $1.7 billion to $1.8 billion as of December 31, 2025. Additionally, there were increases in long-term debt on various other pages, totaling around $26.8 million and $3.3 million. However, the interest expenses have shown mixed results. On some pages it is reported that interest expense has increased, such as a net increase of $16,228 and an increase from $17,454,000 to $19,299,000 in 2025. But on other pages there are decreases noted, including a 6.8% decrease of $403,000 and a drop from $5,969,000 to $5,566,000 in 2025. Management's outlook on company strategy: the company is optimistic about its future prospects, driven by growth in natural gas demand from electric vehicles and heat pumps. To maintain its strong position in the New Jersey market, NJNG will focus on providing safe and reliable service. The company expects to see an increase in revenues due to rate increases approved by the BPU, which will contribute significantly to its bottom line. In addition to revenue growth, management plans to invest in infrastructure projects, including new utility plant expenditures associated with customer growth and pipeline integrity management. This investment is expected to drive growth and increase base rates by $157 million through a stipulation of settlement approved by the BPU. The company also aims to recover MGP-related costs through a regulatory-approved mechanism, RAC, and continue to incur remediation expenditures. Management strategy also includes investing in natural gas storage and transportation assets to drive growth, as well as continuing energy efficiency programs such as SAVEGREN. These initiatives are expected to increase annual recoveries by approximately $13.3 million and contribute to the company's overall growth prospects. With a solid financial foundation, NJNG is confident that it can meet its working capital expenditures, and dividend requirements for at least 12 months. The company's financial history reveals a commitment to rewarding its shareholders. As indicated on page 8 of the report, one key aspect of this commitment is the payment of dividends. Specifically, it states that the company has indeed paid dividends, signifying a focus on returning value to its investors. This practice demonstrates the company's confidence in its financial performance and its desire to share its success with those who have invested in it. The recent financial reports of a company have raised concerns about potential issues with inventory buildup and supply chain disruptions. One major concern is the significant increase in inventory levels, which have risen from $5,247 to $22,921 over the past year. This substantial growth may indicate that the company has accumulated more stock than it can efficiently manage. Furthermore, there are also risks associated with physical commodity contracts. If counterparties fail to perform their obligations under these contracts, the company could face potential losses. Additionally, economic hedging related to natural gas inventory has had negative effects on the company's finances, resulting in significant losses of $8,567,000 in 2025 and $9,527,000 in 2024. The high level of deferred revenue, standing at $66.2 million as of December 31, 2025, also raises concerns about inventory buildup. This is because natural gas inventory is not recognized in earnings until it is withdrawn from storage and sold. The increase in natural gas purchases by 31.3% during the 3 months ended December 31, 2025, may further exacerbate these issues. Overall, these concerns suggest that there may be significant problems with inventory buildup or supply chain disruptions affecting the company's operations. That concludes the financial summary for New Jersey Resources Corporation. Feel free to comment below, and I will be happy to answer them when possible.